This is Chapter 13, the Intro to Mortgage Finances, Lesson 9. Now, I'm telling you ahead of time, I'm not going to do any math questions, but I'll do everything else. Question 12. Which of the following elements are considered in determining appropriate rates of interest on loans? The answer is 4, all of the above. Number 1, the credit rating of the borrower. Number 2, the type of property used for security. And number 3, the amount of administrative attention required on the loan. And then we go to question 68. Right, math question, don't do it. All right, so I'm just going to make notes here for math questions. All right, question 117. Which of the following is characteristic of a mortgage as an investment? And the answer for 117 is 2. Mortgage requires a high degree of admin work. Are you sure about that? Well, we'll have to check this one out. 142, on a straight line principal reduction loan, the monthly payment, number 4, declines over time. All right? Straight line, decline. Straight line, decline. Remember that. 160, by extending the amortization period of the loan, the answer is 4. The repayment of principal is spread over a greater number of payments, making each payment smaller. Okay? Just like my own loan, they made it 30 years, so each payment became smaller. Yeah. So we got page 3 happening here. And I just want to take a note here, 68. This is math. All right. And what's the question I was not sure about? Okay, this one I'm not sure about. All right. 171, 197 are math. So this is going to be a very short chapter, seeing how most of them are math. 203. Which financial institution is currently the largest single source of institutional mortgage funds in Canada? And the answer is number 4, chartered banks. Chartered banks are the biggest source. 250. Calculate the nominal interest rate compounded quarterly that is equivalent to 1.5% per quarterly compounding period. And that's super easy. We want to have nominal rate of interest, okay, which is, as far as I know, it's typically yearly. And so we've got quarterly 1.5. So what do? We go 1.5 times 4 equals 6. So the answer is 6, even though this is sort of a math question. All right, and then now we've got 258. Which of the following is characteristic of a mortgage as an investment? And the answer is 4, all of the above. 1, illiquid relative to government bonds. 2, requires a high degree of admin work. And 3, requires a high initial outlay of capital. So this is a characteristic. Government bonds are much more liquid. You need a high degree of admin work, and you have to have a high initial outlay of capital. So that's, all right. 261, which of the following is the best reason for an investor to choose to use debt financing rather than all cash in order to purchase an income-producing property? And the answer is 3. An investor can obtain the debt financing at a lower interest rate than the expected yield on the project. All right? So your yield is much more than your interest rate, and you end up making money. And question, page 6. No, that's a math question. Let me see here. 267 is a math question. All right, then. So page 7. 276. The risk involved in being a mortgagee, a lender, is what? Number 4, all of the above. And all of the above is 1, greater than the risk involved when investing in Canadian government bonds for a similar time period. Yep. Government bonds are the lightest risk. And then we've got the 2, acceptable to many investors if the interest rate is high enough. All right, if your interest rate is high, then being a mortgagee, a lender, is less risky. And 3, reduced through careful risk is reduced through careful appraisal of the value of the property and the credit rating of the borrower. All right, so all of the above. Page, what do we got going here? 276, I repeated it. Oh well, whatever. And then 283 is a math question. Page 9. We got 290. Mortgage interest rates are sometimes described as being sticky. That is, changes in mortgage rates tend to lag behind changes in bond yields. One reason for the stickiness is, number 2, the weak secondary mortgage market. All right, a weak secondary mortgage market. Secondary mortgage market is kind of risky, just like 2008 financial crash. Think Detroit. 292. A mortgagor would prefer a straight line principal reduction plan to a constant payment plan if number 2, the mortgagor foresees his or her income decreasing. So if they see the income is decreasing, then they prefer a straight line plan rather than a constant payment plan. All right. And let's see, 313. Calculate the semi-annual periodic rate of interest that's equivalent to 12% per annum compounded semi-annually. So you've got a, as far as I know, nominal rate, which is 12% per year, but you want to have the semi-annual periodic rate. So semi-annual means J2, and you would take a J1 of 12, split it into a J2, and that comes out to 6%. Take the 12 divided by 2, and then it's 6%. Pretty easy, huh? 373 on page 11. Which of the following is the main reason that interest accruing loans are normally written in for shorter terms? And the answer is 3. The lender's return and original investment are at risk for the entire term of an interest accruing loan. So the lender's return and original investment are at risk for the entire term of the interest accruing loan. So that's number 3. 374, that is a math question, so we will forget about it. Then we got page 12, 376, math question. 378 on page 13. From the point of view of the lender, the interest charged on a mortgage does not represent, number 2, the cost of financing the lender's debt. From the point of view of the lender, the interest charged on a mortgage does not represent, 2, the cost of financing the lender's debt. No, because it's a gain. So it's, why not? Anyways, that's what the answer says. Obey. All right, and then we go over to page 14. 424. 2 mortgages requiring level blended payments are identical in all respects, except that one has a 5-year term and the other has a 2-year term. The monthly payments on the 5-year term mortgage would be 3, the same as those required on the 2-year mortgage. And that is the truth. 460. Which of the following is a reason why an investor would use borrowed funds instead of an all-cash offer for a real estate investment? And all of the above. 1, lack of adequate capital to make the desired investment. 2, to release equity for home improvements. And 3, to reduce overall risk by using only part of the borrower's total funds for any one investment. So it's better to borrow funds instead of using all cash, so that you can, maybe you don't have enough money, 1. Number 2, you want to have a little bit of equity so you can do home improvements. So 3, you reduce your risk instead of putting all your eggs in one basket. All the answer is 460 for all the above. Okay. And then we go to, let's see, page 15. No. Page 16. No. Well, we're running into almost all math questions here. Page 17. That's another one. Wow. All right, page 18. 551. In mortgage financing, a constant payment mortgage is number one, each payment is identical to the preceding one. So mortgage financing, a constant payment mortgage is one where, number one, each payment is identical to the preceding one. 587, the secondary mortgage market is two, the market in which existing mortgages are bought and sold as financial investments. Secondary mortgage market is the market in which existing mortgages are bought and sold as financial investments. Okay. 589. Constant payment repayment schemes developed in response to for principal risk. So constant payment repayment schemes developed in response to for principal risk. Alrighty then. So then we go to 19. No, those were all math questions, so forget about them. Page 20. That's also a math question. Okay, page 21. All right, 640. All other things being equal, the type of loan that with the most risk to the lender is, number one, an interest accruing loan. So the riskiest loan is, number one, an interest accruing loan. 674. Which of the following is not a characteristic of a mortgage as an investment? And the answer is 3. Mortgages require a low degree of admin work. That is not true. It's not a characteristic. But these other things are true. Smaller investors face a mortgage payment reinvestment problem. Yes. 2. Mortgages require a high initial outlay of capital. Yes. And 4. Mortgages are unique, which makes them difficult to trade. Yes. But number 3, mortgages require a low degree of admin work. That is the answer of not characteristic. Alrighty then. So, question 22, page 22, forget about it. And then 23, forget about it. And let's see, 24. 698. Which of the following are private lenders? And the answer is 4, all the above, which is 1, mortgage corporations, 2, vendors who carry a part of the purchase price by granting a mortgage loan on a property, and 3, trust companies whose estate and trust funds are invested in mortgages. So you got mortgage companies, vendors who do VTB, and trust companies, all the above. 705. In which of the following mortgage repayment schemes do the monthly mortgage payments increase on a regular basis? And the answer for 705 is 2, graduated payment mortgage. So graduated payment mortgages is where monthly mortgage payments increase on a regular basis. Who would want those? 739. With which of the following loans is the lender's initial capital and periodic income at the greatest risk? And the answer is 2, interest accruing loans. So that is where you have the biggest risk, interest accruing loans. All right. Forget about page 25. And let's see. Page 26. Okay, let me see here. 752. A 46 grand second mortgage with interest at the rate of 15% per year, compounded monthly calls for monthly payments of $555. The loan is based on, number 4, it is impossible to determine with the information given. So if we got 46 grand second mortgage with interest rate of 15% per annum, compounded monthly calls for monthly payments of $555, the loan is based on 4, is impossible to determine with the info given. Why is that? You've got your PV, 46 grand. You've got your interest at 15 grand. And you got your periods per year, which is 12, and the monthly payments. And then you got payment is 555. So what are you missing here? You got your N, you got your payment, you got your IYR, you got your PV, and okay. So anyways, this is not really a math question. This is a question whether it's interest only, fully amortized, or partially amortized. 759. And let's see, that's a math question, so forget that. Page 20. 7, math question. And 776. Between 1900 and 1920, 776. Number 1, interest-only loans were the primary focus of repayment for residential mortgage financing, whereas after the Depression, long-term fully amortized mortgages were the primary form of repayment for residential mortgage financing. So there's a big shift. So in the first 20 years of the 19th century, it was interest-only loans. Later on, after the Depression, switched over to long-term fully amortized mortgages. All right, you get that there? All right. And cruising right along. Yes. Page 30. 810. Which of the following is not a primary motivation for investment in real estate? And 810, the answer is 3. A need for short-term funds to finance the acquisition of chattels. That's not motivation for investment. But 1 is true, diversification of investment portfolio. 2, acquisition of a portfolio, the income from which will benefit the investor in retirement years, yes. And 4, a desire for accommodation for residential or economic activities. So you want accommodation. But if you want to have short-term funds for buying chattels, you can forget that. 823 is a math question. And then we go to 844. Which of the following was created by the Canada Mortgage and Housing Corporation, CMHC? And the answer here is, we've got 3, the Canada Housing Trust Bonds. So Canada Housing Trust Bonds created the Canada Mortgage and Housing it was created by the Canada Mortgage and Housing Corporation, CMHC. They created the Canada Housing Trust Bonds. All right. 909's math question. 920. Which of the following is true with respect to mortgage default insurance? And the answer is 2, B and D. B is a lender may apply a higher loan-to-value ratio to an insured loan than an uninsured loan. Okay, so if you got an insured loan, you're going to have a higher L-to-V ratio. And D, mortgage default insurance is insurance for the lender. Those things are both true. All right? Forget the rest. Okay, 935 is a math question. And then we've got the last page here. Where we got here? I think I already did the last page. Oh, I think I skipped something. Hey, I've got a repeat here. I'll get the repeat. Alright, I guess I'm done. I just was screwing around with my papers. Screwing around with my papers. Oh, no, I got some more here. Okay, 946, a math question. Alright, last one here, 997. Which of the following is not a reason why an investor would use borrowed funds instead of all cash offer for a real estate investment? And the answer is 2, to get a regular and predictable return on capital. So that is not a regular and predictable return on capital. So that's not a reason. But these other things are reasons. Number 1, to diversify investments and reduce overall risk. Number 3, to invest the borrowed funds at a higher rate of interest than the borrowing rate. and 4, lack of adequate capital to make the desired investments. There you go.